Hello, everybody. This is Dr. Gary Merzinski from Luzerne County Community College. This is Principles of Economics 2, Microeconomics. We are in Chapter 12. This is Part B, and the final part of Chapter 12, where we are discussing monopolistic competition as a market structure. This is where there are many sellers, dozens of sellers maybe, of a product. The products are similar, but they're not standardized products. This makes them different from pure competition in that each firm has the ability to differentiate its product in the minds of consumers and convince them that their product is superior in some way. And that gives them some control over price. So their individual firm demand curve is not horizontal for this reason. It's downward sloping. So we're going to look at what this looks like graphically in this video, and you can see the graph you're looking at there looks just like the graph you saw for a monopolist. So this is what it looks like for any market that is considered imperfect competition, not pure competition, in other words. There's a downward sloping demand curve. There's a separate downward sloping marginal revenue curve. You remember the explanation for that. I explained that a couple of times. It's just a mathematical reality. If it's a downward sloping demand curve, then the marginal revenue curve is going to be a separate downward sloping curve, and price, which comes from the demand curve, will always be greater than marginal revenue, except where Q is equal to 1. All right, so we have that separate downward sloping curve for marginal revenue. It is used to determine the profit maximizing level of output. You look for the intersection of marginal cost and marginal revenue for the individual firm. That's point K on the graph. You drop down to the x-axis, and whatever quantity corresponds with Q sub A, that's how many this firm will produce and sell per week in order to maximize profit. So then you follow that vertical dashed line up to where we intersect with the demand curve to get the market price, or the price you would charge at the profit maximizing level of output, and that is point F. So the price would be P sub A. That would be the price this firm would charge, and they would sell Q sub A. That's where they would maximize their profits. So what is their profit? At Q sub A, on the x-axis, again go up the dashed line to see where you intersect with the U-shaped average total cost curve. That corresponds with an average total cost of C sub A, whatever that is. So then profit equals P minus ATC, that quantity, times Q. So it's the shaded, orange shaded area on the curve that represents profit. We've seen this before. It's not any different from a monopolist. Again, this is the individual firm. They will maximize profits where marginal revenue equals marginal cost, the quantity that corresponds with that point. If the typical firm in a monopolistically competitive market has a revenue and cost structure that is described by the graph we just saw, then they are profitable. There are no significant barriers to entry in this kind of a market. That will attract market entrants. New companies would want to flood into the market because they see how profitable the businesses that are currently producing and selling in this market are being. So they will want to be that profitable, and so that will attract market entrants. On the right, that is the demand curve for the individual firm, and you can see that as firms enter, each existing firm's market share shrinks. So then graphically what that means is you have a decrease in the overall demand for your product. So your demand curve is going to shift to the left. It's also becoming more flat, in other words, more elastic, because now whatever differentiation you were successful in establishing, now there are many more sellers because more and more businesses are entering in this market. And so you've got to focus even more on product differentiation, maybe. So the demand for your product has become more elastic as these new firms come into the market. If you look on the left now, that is the market demand curve and supply curves. Remember, the marginal cost curves of the individual firms are really the supply curves, and the aggregate of the marginal costs of all of the sellers in the market make up the market marginal cost curve, which is the market supply curve. And it starts with the dashed upward sloping curve. That's the initial marginal cost curve for the industry, the supply curve. And then as firms enter, increase in overall supply, right? There's an increase in the number of sellers. That is the supply curve shifter. We learned that in chapter 3. And so it ends up being the solid upward sloping blue curve. That is the market marginal cost curve after the shift, after the entrants have entered. Long-run equilibrium is depicted in this graph for the monopolistically competitive seller. Initially, the demand curve is the dashed demand curve to the right. If that's the case, then this seller is experiencing a profit. That, however, will attract market entrants because there are not significant barriers to entry with the monopolistically competitive market. And as new sellers enter, each existing seller sees their market share shrink. So their demand curve shifts to the left. So the dashed demand curve shifts to the left and will eventually become the solid green demand curve, the downward sloping demand curve. And equilibrium will occur at point G. So what happens is this seller will produce where marginal revenue and marginal cost are equal to each other. So you look for the intersection of marginal revenue and marginal cost. So the downward sloping dashed green curve below the solid green demand curve, that's the marginal revenue curve, where it intersects with the blue curve. So that's a profit maximizing level of output of Q sub G. That's how much this seller will produce. The price will be, look at point G, P sub G. That's the demand curve. That's where you get price from. What is average total cost at point G at that price? It's the same as the price because it's touching, the demand curve is touching the average total cost curve. Remember, this happened with pure competition too, right? So profit is equal to 0 because price is equal to average total cost. But don't cry for the seller. As we discussed in chapter 8, if economic profit is 0, there still is an accounting profit because an economist considers normal profit to be a cost. So this seller is still experiencing a normal profit. And to remind you what that is, normal profit is profit that this entrepreneur, this seller, should expect to experience in the next best alternative use of his or her entrepreneurial skill and resources if they had started the next best business, the next best alternative venture. Whatever that profit would be, that fair profit, they include that as a cost. And so they're still experiencing an accounting profit is what I'm saying. All right, so now I would like to address efficiency. There are two types of efficiency, productive efficiency and allocative efficiency. First, productive efficiency. The degree to which a market is productively efficient is the degree to which producers, sellers, are minimizing the productive resources used to produce the product. If you remember pure competition, that's the best you can do. That's the ultimate productive efficiency. The demand curve for the purely competitive producer was a horizontal line, and they produce where long-run equilibrium will be where that line is touching the average total cost curve. Well, it has to touch it at the bottom. This is pure competition, not monopolistic competition. So envision, if you could, a horizontal line that touches the bottom of the average total cost curve, which is also where marginal cost intersects. That was pure competition. That was their long-run equilibrium. Well, that's the best you can do. That's the minimum. That's the bottom of the U-shaped average total cost curve. That is the most productively efficient. So we're not at the bottom of the U here. We are touching the U, but at a point that's a little bit to the left of the bottom point, right? So it's not as productively efficient, but it's still very good. It's still better than oligopoly. It's still better than monopoly in terms of productive efficiency, but not quite as good as pure competition. Now, allocative efficiency, that's the other kind of efficiency that's important. That has to do with whether the productive resources in the market are being used as society would want them to be used to produce the right mix of goods and services that society desires. And remember, the best you can do, again, back to pure competition, is when price is equal to marginal cost. Price is the value of the product per unit to the consumer. Marginal cost is the value of the productive resources used to produce the product per unit. And so the best you can do is when price and marginal cost are equal to each other. So you look for price, that comes from the demand curve. So see the downward sloping solid demand curve, we're in long run equilibrium. Look at where that intersects with the blue marginal cost curve. That would, if we were producing there, would give us a larger Q than this seller will be producing. So we're not as allocatively efficient as if it were pure competition. You would only be producing there for pure competition. But this is monopolistic competition. And this seller is going to want to produce where marginal cost is equal to marginal revenue, not price. And that gives us, look for that intersection, that gives us a smaller Q, Q sub G. They're going to want to produce at the profit maximizing level of output. And even though profit is zero, that's the best they can do profit-wise. So it's not as allocatively efficient as pure competition, but it's still pretty good, and it's better than oligopoly, and oligopoly is better than monopoly in terms of allocative efficiency. This is explained on the next few slides, but I wanted to do it here while we have the graph in front of us. So this slide is addressing productive efficiency. As I said, the best you can do is when you're producing at the bottom of the U-shaped average total cost curve. That happens with pure competition because you've got that horizontal demand curve that settles at the bottom of the U, because that's where marginal revenue, which is your demand curve with pure competition, is equal to marginal cost, which is equal to average total cost. All three of those graphs intersect at that point. That's the best you can do. That's the minimum amount of cost per unit. We're not there with monopolistic competition. Price and average total cost are the same thing, great for the consumer, but we're using a little bit more resources per unit than the minimum. So not as good as pure competition, again, but better than oligopoly and better than monopoly. There's also excess capacity, which is allocative efficiency, which we'll explain on the next slide. Again, allocative efficiency is when the market is producing the right mix of output that society wants, and graphically that happens where price is equal to marginal cost. We're not producing there. We're producing where marginal revenue is equal to marginal cost. And so we're not perfectly allocatively efficient as happens with pure competition, but we're still very good as compared to oligopoly or monopolistic, or monopoly, I mean. At the end of chapter 12, there's a discussion of advertising. Advertising is non-price competition. And non-price competition could include improving your product in order to differentiate it from consumers, or spending money on advertising to convince consumers that your product is superior to your competitors' products. That's non-price advertising. So let's back out a little bit and think of each of the market structures. With pure competition, it's a standardized product. So there's no sense in engaging in non-price competition. The products are standardized products. You can't convince consumers that one seller's milk is better than another seller's milk. Milk is milk to the consumer's mind. And so they don't engage in non-price competition, only price competition. All the way at the other end of the spectrum, monopoly, there's no competition whatsoever. So they don't engage in non-price competition there either, or price competition. But the two in between, oligopoly and monopolistic competition, there's a significant amount of non-price competition. Remember, with oligopoly, they're very reluctant to engage in price competition, and that's represented by the kinked demand curve. And so it's non-price competition, a lot of advertising and promotion by sellers in oligopoly markets. It happens also in monopolistic competition. So, to a lesser degree, though, monopolistically competitive sellers also are somewhat reluctant to engage in price competition, so they engage in non-price competition, a lot of advertising. So that's what we're discussing here. Consumers can claim that this is bad for the economy, bad for the consumer for sure, because to the extent that a business is spending money on advertising, if they had saved that money and instead spent it to improve their products or lower their prices, that'd be better for the consumer. You're going to see in a couple slides from now how much money is being spent by the largest advertisers in our economy, and it's in the billions of dollars per year. Well, those billions of dollars, if the seller didn't have to spend them, that's a cost for them. The prices would be lower, and that's better for the consumer. Or the quality of their products could be better. Two of the sellers that spend the most on advertising are AT&T and Verizon, competitors. I think they're number 3 and number 6 on that list. Well, if they weren't spending those billions of dollars on advertising to compete with each other, they could be using those billions of dollars to improve their infrastructure and have more reliable and faster phone service. So this is what the consumer might say in criticism of all the money that's being spent on advertising. There's also a discussion of truth in advertising. The more advertising there is, the more likely there's going to be untruths in the advertising. The businesses that do the advertising might respond this way to those kinds of criticisms. They might say that they have a free speech right to promote their products, and they do that through advertising. And they also might claim that if they're being untruthful, their competitors will call them out on it. So if Ford is claiming that their cars are safer than General Motors, or or perform better, then General Motors can have counter advertising to dispute those claims. And this is what an advertiser might say would limit the amount of untruth there is in advertising. But one thing's for certain, as long as it's imperfect competition, which is oligopoly, monopolistic competition, and monopoly, then there's going to be non-price competition. These are the largest advertisers, and you can see these are all oligopoly markets except for one. So there's more non-price competition with oligopolies than with monopolistic competition. But which one is the non-oligopoly market? It's number 2, Procter & Gamble. But one thing I have to point out here is Procter & Gamble is the largest producer of consumer goods in the world. So those $4.4 billion are spread across many, many, many products in many different product lines, whereas AT&T and Verizon, all that money is being spent on one product, phone service. And General Motors and Ford, you can say the same thing. Even though it's a product line of automobiles, all of it's being spent in the same industry. Procter & Gamble, their products are in many different industries. But that gives you an idea of the enormous amount of money that's being spent on advertising. And this is as of January 2020, right before the pandemic. So the numbers are larger now, but still in the billions. Why do you spend money on advertising if you're the seller? You want to establish, maintain, and improve your brand loyalty, grow your brand loyalty. You want for the consumer to come back to you again and again, and that gives your brand value, brand equity. This is a list of the top 10 most valuable brands. Now, these are estimated numbers. Where they come up with these numbers or how they can do this, I have no idea. But this is someone's estimate of the value of these brands. So if Coca-Cola were to, for some reason, want to sell their brand to someone else, Pepsi or some other cola producer, and give someone else the right to use the name Coca-Cola and their formula to produce their product, it would be worth $57 billion on the open market if someone were to buy that from them. That's what this means. This is not the same thing as market cap. Market capitalization is the value of the company. So that's a different list and much larger numbers. Apple and Microsoft, I think, are number 1 and 2 on that list, but they're in the billions. They're around 3 billion, just over $3 billion. That's something different. That's if you were to sell the whole company, which then would include all of their capital, all of their facilities, all of their technology, cash they have, and both of these companies have a lot of cash. That would amount to $3 billion, so 1,000 times these amounts. 100 times these amounts. But this is a measure of brand loyalty to estimate the brand equity of these different product companies and their products. So that is it for chapter 12. And that is it for the market structures. We've just gone through pure competition, monopoly, oligopoly, and now monopolistic competition.